Okay. Good morning and welcome to all of you to our webinar Back to the Future. Thank you guys to join, and let's go to introduce all the audience that we have today. In the past few months, the world around us has changed, and in this context, the real estate market has been one of the sectors most impacted by the pandemic crisis. Not only in the short term, but also with a prospective view for the future. The aim of this webinar is to provide our guests with information of what is going on in Europe, in Middle East and Asia in terms of real estate. As we are all aware, the Italian investment market as well all the other European markets are linked together. Nevertheless, sometimes Italy has been influenced more by what we think of ourselves from what is the real perception. Our today's goal is to provide you with a different point of view. In this particular moment, it's really important. To do what, we've invited a few colleagues and friends that are part of the BNP International Investment Group, so-called IAG, a team of over 40 professionals with the aim to facilitate and improve the flow of the capital into and among the European countries. Today's guests are Larry Young, head of the IAG, Javier Gomez, Senior Director of the IAG in Germany, Mr. Yo-Hann, CEO of the Asia Pacific, and Mr. Fadi Al-Khatib, CEO of the Middle East. We go also to see Thierry Bougeard, that is our head of Pan-European of Logistics team. Thank you guys to join our webinar, and let's go through. And the idea is to start with Larry and Javier, with in particular focus to the European context, and let's say to the main economics like France, UK, and Germany, but also with a European perspective. From your side, what is happening there, and also what is your view on the Italia?
Daniele, thank you very much, and thank you everybody for joining the webinar and having us joining this. So I think that the main question to be asked is, how much is this COVID period affecting the European markets? And I think, when are we going to recover, and how is Italy going to recover, and how we can help from I think the rest of Europe and the rest of the world. I mean, just a few figures, and we'll be looking through a presentation as we're discussing. But in terms of GDP in Europe, it's looking like a drop of around 10%. I think the provisions change on a fairly regular basis and really depend on each country. Personally, I'm based in France, and the market has opened up pretty well. People are back to work, and generally, when we're seeing economic provisions, they are positive. Other countries, and Javier will obviously speak about Germany, is positive due to the situation. But other countries where the lockdown is more difficult, they are going to take longer to get out of that negative GDP situation. And I think the latest news hopefully has buoyed everyone of the European leaders, finally, after a long time of negotiating, agreeing the 750 billion euro bailout package. So we're hoping with that, and obviously the avoidance of second waves across Europe, to see the rebound that we're predicting. And maybe what I'll do is I'll hand over to Javier to discuss some of the main GDP figures, and then we'll go a bit more into the micro details of the actual market.
Javier, I think that you are in mute.
No, we can't hear you yet, Javier.
Javier, we still can hear you. Sorry.
Okay, try it again. Can you hear me now?
Now it's perfect.
Okay.
That's the beauty of the live. Exactly.
Yeah.
Thanks.
So we are real estate guys, not the technicians at all.
Exactly.
Yeah.
happy to be in this panel and have the chance to speak about Europe, the link from Germany to Italy, and as Larry said, where we are with the economics. But before I start, Daniele asked me to give you a bit of background how Germany went through this lockdown period, to give you a flavor and where we are today. Today we are back to normal. Our offices are completely in operation. Of course, we have installed some sanitary situations like crystal walls, and of course we have, let's say, some runways in the offices. But in principle, we are back. The market looks pretty stable. Yeah, so we're doing a lot of business. We have a enormous pipeline for Q3, which we're already in, and the Q4. From that side, it looks good. We went through the pandemic, I would say, in a somehow smooth way. Of course, the lockdown was clearly said to us that everybody has to stay at home, but nevertheless, we were able to go out, and that was quite helpful for the mood in general. So I was, for example, cycling in the woods here, and on the countryside, people went to some parks, of course, in smaller groups, very often as single persons. So all in all, I would say Germany went quite stable through this pandemic. The mood is positive. The economic data are looking positive. Nevertheless, we have to stick together as a European powerhouse. Here, Larry already mentioned the fact that we were able to create this fund, which is for Europe a big signal to the rest of the world. And then let's look how we can use this. On the slides, I don't know how you can see that. We've prepared some slides. I think the gross domestic product, it's no surprise that it went down everywhere. The rebound looks like a V shape. Personally, I would say is they are not just the pandemic effects which we have to consider. You know, we have upcoming votes in the US. Maybe it's a bit more U-shape, but we have to see. It's too early to give any prediction how it will really like. But all in all, what we see from our bank in the background, which is always a help when it comes to such numbers, is that the outlook looks positive. On the unemployment rate, the same. Of course, it will increase all over Europe, all over the world. In some parts of the world, it has already happened. The good thing, I would say, in this crisis is the fact where we are coming from. When we're talking about Europe, all in all from a lower level. So the effect in comparison to the financial crisis is, I would say, much smoother. Nevertheless, when I hear, for example, Mercedes just announced this morning that they will release 30,000 employees on the Mercedes side, so not just in Germany, all over the world. We have to see how this unemployment rate will look like in a couple of months. Yeah. That inflation is coming. I would say on the one hand, it's not too nice to see that, but on the other side, we need it for all the debt we are creating all together, personally and as a society, as a European society, so that the inflation will help to come out of this. It's clearly that the policy rates will stay very stable. Is as well a good signal towards a positive trend of the economy, and and where the governmental bonds will be or where they are, it looks like they will keep this low level for a longer time and not too volatile, which is a good signal that the global markets are thinking that Europe is a stable haven, not just Germany, Europe as a whole. And again, we have seen that this, let's say, shoulder and shoulder situation for the fact that we have now this fund coming. Larry, maybe some words to the real estate market as a whole.
Sure, no problem. So, I mean, if we go on to what's gone on in the office market, Thierry obviously will come in a bit later, more specifically on logistics. But in terms of office take-up, it's gone down, as you'll see on the slides, by almost 44% compared to 2020. 2019. So it has been impacted, and probably we'll see later on the investment market. I think some of the office markets have probably taken the brunt. Really a case of companies delaying decisions, companies not moving. Also, some of the impact that we saw before on the co-working situation, and I think it's really this debate that's kind of ongoing across Europe on whether people are actually going to go back to work or whether people will be spending a lot of time doing home working is showing an impact on the office market. Where we're seeing sort of parts of the market that are more stable, I think, are the smaller CBD locations, the smaller lettings, but the big moves by large corporates across Europe have been put on hold. What's positive, though, is we should see a reasonably good rebound. And as you see, especially in Germany, Advisory 9, just for information for the clients, is a term we use for all the countries outside UK, France and Germany where we have offices, obviously including Italy. And London market had been impacted fairly severely because obviously there was the Brexit situation. But because of that, there hasn't been a huge amount of oversupply. So just going on to supply on the next slide, there isn't any huge worries across Europe, I think, in terms of supply. And what is positive is markets came into this with low vacancy rates in all the key markets. I mentioned London, the fact that with the Brexit impact, pretty much a lot of development had already stopped beforehand. The German markets are holding up well. Where I am based in France, I think we probably need to keep an eye on what's going on, especially around the La Défense market, where there was quite a bit of development there. So maybe some pockets of places where there's a bit too much supply, but generally the CBDs all went into the market with such low vacancy rates that we're not seeing such a big impact. So in terms of take up, obviously that's dropped everywhere, and I think that's going to be an impact from the market on the next slide, showing how that take up is going to be affected and going to carry on being affected. But really the tenants, I think, will focus on the CBD, and then maybe I'll sort of go on to the rents on the page afterwards. Because of the lack of significant supply, because of generally CBD rents and lettings remaining dynamic, we're not seeing any massive rental drops in the core markets. And I think where we're seeing them would be some of the peripheral markets where you have very large amounts of stock, and that can be more complicated. So maybe I'll hand you back to Javier just to finish on the investment market.
Yeah, on the investment market, I would say it's a similar picture. All over Europe, we had on the next slides, we had a super strong Q1 in all European countries, and then the big hit arrived, and I would say basically after the lockdowns, where all the markets went down around 40%. In Germany, we had a 20% reduction on the commercial side, and then when on the last page on the investment market, we see a bit here where we are and how does the future looks alike. I would say even this is we say it's a base case. Of course, we have a further look, a more positive one, because we all agree real estate, the bricks, and so on is one of the main asset classes which survived much better than stocks and everything else. So my personal feeling, and when I talk to the pan-European investors and Fadi and Yo-Hann, which will speak afterwards, will underline this. The interest in real estate is super, super high. And I would say the rebound will be even stronger, and that we come in a much higher level back as we have drafted here. That's, I would say, among us professionals in the day-to-day business, the rather this view than from our research department. So the future looks really good. We have just to look a bit the relation to the take-up market, how this might be. This, of course, will have a certain impact. And then what is behind this this graphs is as well the difference between the different use classes. You know, we have the offices which holding up extremely good. Healthcare is coming quickly out of I would say niche product up, like logistics. Some years ago, logistics is a super strong use class, and yeah. Last but not least, we have to see how retail comes out of the ash and recreates their business. And the hotel industry, yeah, we haven't seen, you know, the events before. Either it was, you know, some attacks from wherever of the world. We've seen it with this volcano clouds that the hotel business dropped down. I think hotel is just a matter of time, and then they will be back. So, and last but not least, residential, to mention is here. Residential was as well somehow a niche product, but it comes to more and more to a commercial product all over Europe. So if you take this all, you know, as a whole, the future in real estate looks like positive all over Europe. Yeah.
Okay. Thank you very much. Thank you, Javier. Thank you, Larry, for sharing these. And so, let's say, just to summarize, I would say that that was the perception of Europe. Clearly, we had a second quarter that, let's say, was difficult, but I think that this was something that we can assume. And clearly, from our perspective, from the Italian perspective, looking what is happening right now in Germany, UK, and France is very important. So let's say, seeing this pipeline of investment in Germany, I think is that something that really looks also from our perspective a good news. This is just a short summary of what is happening today in Europe. But as I mentioned at the beginning, I think that we need to see to give a perspective of worldwide. That's the reason because I asked to my friend Fadi and Yo-Hann to join, because we would like also to see what is happening abroad meaning also outside Europe. So let's say the feeling is what is happening and well, where actually start these crises in terms of sanitary crisis, the COVID in Asia, what is happening today, what is the outlook, and in particular, since they were very active in the past 2018, 2019, the investor, what is the outlook for Europe and for Italy? So, Yo-Hann, I leave the speech to you and to Fadi, and up to you.
Hi, thank you, everybody. Perhaps I'll start first. I'm Yo-Hann. I'm based in Hong Kong, and it's a great opportunity to be sharing our thoughts with you. As you know, in Asia, we had the first wave of the pandemic and all that, and today we are in, depending on which city you're in, we are experiencing the third wave of pandemic infections, and that is Hong Kong. Singapore is still very much in a lockdown scenario. Korea in Seoul, business has slowly come back in terms of normality. Live people are meeting each other, but still in a very, very restricted format. Social distancing, a ban on mass meetings and gatherings is still very much in place, and we are seeing a adjustment to a new normal life. Now, how does that impact on business, specifically on real estate and real estate in the form of Asian investment into Europe, specifically Italy, and also real estate investment in your home countries. Okay, in terms of home real estate investment in Asia, as you know, there's very much the big issue of the trade war that's happening between China and the US. That has sent a lot of alarm in home countries like China, in Hong Kong, in Singapore, where you have investors seeking safe haven investment in other countries outside Hong Kong, outside China, and that we are seeing a lot of that. Okay, now in Asia there is a lack of stock, and what that has immediately impacted investment into Europe, into elsewhere, is what we hear from a lot of our clients is that they want to invest out into Europe. Specifically, you would see drivers caused out of Hong Kong, political issues that has forced money to be allocated towards Europe. You see continued robust appetite from the Koreans, from mainland Chinese, from Singaporeans and Malaysians. Okay, specifically on the issue of Italy and Milan, the interest is there. It remains robust. It hasn't gone away. We are being asked the same questions as to the Italian GDP, its growth story. We have been even asked detailed questions about the long-term prospects of commercial, office, logistics. In Milan, in Rome, we are being asked about specific areas. We are being asked about covenants. We are being asked about how Italian companies are reacting to the economic downturn. Specifically, we are also asked how the Italian government is responding to this pandemic. And that leads us to the obvious thought, is that Asians continue to be interested in Italy. And to the extent that they will invest in that, it will depend also very much on the governmental response. So the three core areas which Asians are interested in, office, logistics, and hospitality, remains there. We have had on hospitality a lot of queries because Italy will always be there. Historically, Rome, the eternal city, Asians love that. Of course, now they would love to invest and acquire hotels or build hotels throughout Italy. Again, they are looking for value. They're looking if there's any opportunities for discount. So that in itself shows that they believe in the long-term sustainability of the Italian economy and culture. For offices, again, they are looking for value, they are looking for yield, but they've also taken the view that if you have an iconic, good, well-located property that enjoys a long lease, that would be something that they continue to seek for. Fadi, over to you.
Thank you, Yo-Hann. And Daniele, thank you for hosting us on this webinar, and good morning to all from sunny and very warm Dubai. Maybe just to complement what Yo-Hann is saying about the Middle East, we cover the Gulf Arab countries, so it's 6 countries, the United Arab Emirates, Saudi Arabia, Kuwait, Bahrain, Qatar, and Oman. Traditionally, this region started in the 60s by setting up sovereign wealth funds to invest excess oil reserves internationally to diversify away from the region. And as you may guess, the impact of oil prices is extremely important on investor appetite on the governmental side, the government and quasi-government institutions into Europe. So traditionally, the region was one of the early investors into Europe. Typically, in any year, between 8 and 15 billion euros is invested from the region. I think year to date, it's between 5 and 6 billion, which is quite good considering the impact of COVID. And I think on average, for the past 5 years, investors from the Middle East have put about in excess of 3 billion euros into Italy. So Italy is accounted roughly from between 5 and 10% of total Middle Eastern investment into Europe. So we can say there is a healthy appetite into the Italian markets. Similar to what Yo-Hann said, hospitality was of prime interest given Italy's position as one of the key tourist destinations, whereas that be Rome, Milan, or the Amalfi Coast, Capri, and all that. And we've seen investors from Qatar, from UAE, invest in hotels in Italy. There were other investors, Saudi Arabian families that put money in offices and even in developments in Milan. And we've seen also financial institutions that intermediate capital put in some money between 2017 and 18. Well, back to the impact of oil prices and the double impact between oil prices and the COVID-19. Economies in the Gulf were beginning to slow. Some of them registered negative growth in the first quarter. To us, that was further impetus, especially for private capital, all the family offices and the financial institutions that intermediate capital, to diversify from the slowing domestic local economies into Europe. So Europe was seen as a safe haven, as a way to generate income on liquidity. And that's why we saw quite a bit of demand in Q1. The big shock came in, with the decline in oil prices. So the price of Brent crude oil is the benchmark for the region. And our hearts dropped when we saw that March hit $18 a barrel. And now we have a slight smile on our face with crude oil prices at $45 for Brent crude oil. And that's going to help. Nevertheless, from the two sides, from the two types of investors, the sovereigns or the semi-governmental investors, oil prices still have an impact. The break-even fiscal situation for most countries is above $45 a barrel. Only the Qataris, break-even budget-wise at $48, $49. So we're not far from that. And that's why we see continued interest from the Qatari sovereigns, who are historical investors into Italy, continue into Europe. So that's a good sign. The UAE and specifically Abu Dhabi, their break-even oil prices are north of $65. They will incur about a 10% budget deficit this year to sustain the local economy. So we see their demand slightly muted. They will look opportunistically, but that demand will be muted. The Kuwaitis are in a bit of a trouble. Their break-even prices are closer to $75 a barrel. And the forecast is a budget deficit between 25 and 40%. So the oil price has a significant impact on sovereign funds from Kuwait. And then Saudi Arabia, their situation is more or less okay. They've tripled the VAT. They've reduced some of the employment benefits, and they've cut down on budget expenditures to be in a better fiscal situation. But they still plan to spend over $200 billion in fiscal 2020, which means they will incur a 10% budget deficit, and they're tapping into their reserves. Nonetheless, we see them now becoming active on the markets. We see certainly the Public Investment Fund in Saudi wanting to create an impact internationally. So they have made some high-profile investments and recently purchasing big stakes in Citigroup, Facebook, and Amazon, and we continue to work with them. We see more demand for international markets, and we hope as well for European real estate. And their fiscal situation is although challenging, they have over 500 billion in liquidity. So overall, on the governmental side of the equation, there's about $2.5 trillion of excess funds in the sovereign funds. So that should sustain the governments over the next 12 to 24 months. And as oil prices recover, hopefully, then we will see more and more demand from these sovereigns or quasi-sovereigns. The picture on the private capital side, so the big family offices and the financial institutions that intermediate capital, is mixed. We see the most demand from those financial institutions. There is still a decent amount of liquidity in the Gulf. Despite the decline in oil prices, there's a 12 to 24 months lag in the private sector. And that private sector is still looking to diversify into Europe. And they are mostly looking for yielding investments. So they will consider offices and logistics assets. I think hospitality will be put on hold over the next year or two until the sector recovers. But there certainly is demand for assets between 50 and 100 million from a variety of institutions. We've seen investors close deals in the depths of the corona lockdowns. So that's still a healthy sign. Over to you, Yo-Hann.
Thank you. Specifically, you raise a good point, Fadi. In terms of the investor groupings in Asia that will look in Italy and the opportunities there. In terms of sovereigns, we have very much sovereigns in the form of HKMA in Hong Kong, GIC in Singapore, and CIC in China. They have, over the last 6 months, starting to make queries as to investing into Italy. What are they looking for? They're looking for commercial core assets. It is very unlikely that they would go into core plus. To Asians, Italy is a new market because they've traditionally invested into destinations like London, Frankfurt, and Paris. They would be looking for a long vault. This is something which they have continually expressed to us that they need to put money there. They need to invest there. In terms of private family offices, specifically from Hong Kong, from Singapore, there is great demand for hospitality, as I previously mentioned, and also for smaller commercial units. Those in the bracket of up to 100 million euros. We have had many queries seeking that. Reasons for looking at these asset classes, apart from the hospitality self-explanatory, it is they're again looking for yield. They are looking for a foothold in the Italian economic story. Okay, and they also are looking to diversify a lot from their existing portfolio in Asia. So that is one of the main drivers. In terms of liquidity, Asia is awash with liquidity. Given the volatility that is the trade war, we have questions about the Hong Kong peg to the US dollar. You have capital outflows, for example, Hong Kong to Singapore. You have a very low interest rate environment among Asian banks. Asian investors are now flush with cash. So they will, and the pressure to apply their capital towards income producing assets is immense. We have never seen that much pressure building up in Asia. So in that regard, and I was sharing with my colleague Daniele the other day, we would see strong investment flows from Asia into Milan in the foreseeable future, barring a good response by the Italian government to the pandemic. Daniele?
Yes, thank you very much. Good news, I would say. Let's say that, thank you for this view. Clearly, it's important to know very well the market there and also to provide this view from us, from Italy. I would say that we touch base more or less with a geographic point of view. What we suggest is that there are a specific, as told by Javier, few asset class that shows more resilience regarding, let's say, the particular situation that we are living right now. One of these asset class is clearly the logistic, that is for their its importance is also very pan-European asset class. And for that reason, we would like to share from Thierry, that is our head of pan-European logistic team, what is happening there in this specific asset class vis-a-vis Europe, let's say in Europe in particular, because we see that what we see in Europe, we see also in Italy in that specific. So Thierry, I leave this to you. Thank you.
Thank you, Daniele, and As the word logistic has been mentioned by Javier, by Yo-Hann, and by Fadi, I don't need to say that there is a huge appetite for logistics all over Europe from investors from everywhere. But as you said, logistics has demonstrated to be the most resilient asset class during this COVID period. But let's come back a little bit to the past. Logistics for the last 4 years has been very, very active, and the investment volume came in the last 4 years from, there is some noise, I don't know if it's me or somebody else, but can you hear me? Yes, you can hear me? Okay. So I said that over the last 4 years, the investment volume in Europe came from an average of 22 billion euros up to 40 billion euros. So it's clear that logistics for the last years has been an alternative for in investment, maybe to balance over asset class such as, for instance, retail, which has declined a little bit. This trend clearly was confirmed during the first quarter of the year because we reached nearly 9 billion euro invested in Q1 over Europe, which is the best result ever. So what happened during Q2 and during the COVID period? But despite the COVID period, we reached nearly 5 billion euros invested, which means that for the first part of the year, we achieved 14 billion euros, which is more or less a very light decrease of 3% if we consider the 14.2 billion euros invested in 2019, which means that it's an excellent result. And if we consider the second part of the year, our forecast is that we will reach the 30 billions, and we will not be so, let's say, so far from the result over the last 4 years. So this is for logistics investment. For the take-up, it's slightly different because our forecast, due to the let's say the lockdown period, we have a clear decrease in the take-up, in logistic take-up, with a 10 to 12% decrease compared with 2019. This is not true for all the countries because, for instance, there is a particular case which is UK. You know that during the last 2 years, UK was paralyzed by the Brexit situation, Brexit or not Brexit. So we have clearly in UK a post-Brexit effect because the take-up has increased nearly 40%. In other countries like in Central Europe, the activity was clearly very steady as well. In Czech Republic, in Poland, with some increase in take-up. Germany and Netherlands are very, very stable, also with a good activity. And unfortunately, some other countries like France has demonstrated some drops. Let's say France has dropped nearly 40% in the take-up in the first half of the year. So what we can say is, if we had, let's say, an average of 3-4% of rental growth in prime rents in the past, for this year we don't expect any rental growth anywhere, but we don't expect any decrease in prime rents, which is and we think that it will remain absolutely stable for the second part of the year and maybe back to growth in 2021. Obviously, the e-commerce activity is the main driver of logistic increase. In the last years, the e-commerce activity grew an average of 14% each year, which is huge. And the forecast for next years are we consider that it will still increase 10 to 12% each year. This online channel has been clearly reinforced during the COVID period because as everything was closed, people started to buy goods through the online channel. So we had particularly for grocery and essential product a terrible growth in some countries. It came from 5% up to 40%. And in this case, the effect or the impact in the logistic take-up was that everywhere in Europe from March to June, we have seen an increase of short-term space requirements from major supermarkets, for instance, everywhere in Europe. So saying that, what could be the impact on the logistic market? From my point of view, for our point of view, it will be all positive. Why? First of all, because online shopping will benefit from new clients, such as older generations, which have been reluctant to move online, and now are getting used to using this tool, or either for products that consumers previously preferred to buy in store and now are buying through the online channel. Secondly, this COVID period has demonstrated to maybe all the retailers that they were not prepared to such a situation, because during 3 months it has been like everyday Black Friday. So all the warehouses were at suffer disruption. So everybody in Europe is reconsidering its supply chain strategy and its supply chain activity, and they are considering to open new platform, new distribution platform, new warehouses to make a specific tool for the online channel instead of using their traditional warehouses. Third point, we just spoke about e-commerce and retail, but let's consider what happened in the industry sector. Many European manufacturers considered or has seen that they were too dependent from their production in China, for instance, and they are considering to relocate some regional plot of production and stock, particularly in some countries where the labor costs are lower. So we think that there will be some room to more activity in Central Europe, for instance, but also in countries which are not in Europe, which could be the case of Serbia and Ukraine, for instance. And last point, I would say that when we are looking at the vacancy rate of logistics in every single country in Europe, this vacancy rate is quite low. So if we consider the e-commerce growth in the next 3, 4, 5 years, we consider that there is still room to speculative developments and turnkey projects. Okay, so these are the points, and we clearly think that the activity will remain steady for the second part of the year, and with some growth from 2021 onwards. Obviously, if there is not COVID-2 and COVID-3, which we hope won't happen. Just a few words on capital markets. We already said that, and my colleagues already said that. There is a huge appetite for logistics in Europe, everywhere. Unfortunately, during the second quarter, there were all the sales process were on hold before everybody was scared of a potential impact on the pricing if they keep on trying to sell some logistics. During the second part of June and beginning of July, we have launched in BNP some sales process. For instance, we have 2 good examples in Netherlands and in Germany. Through this process, we have received more than 130 NDAs signed, which is an incredible score. and we will expect to receive more than 30 non-binding offers. So it's absolutely incredible. I think I'm not sure it did happen before. So what is the effect on prime yields? Prime yields are remaining absolutely stable despite of COVID. The core assets are not suffering any yield decompression. If we consider core plus and value-added assets, we may have some decompression, but let's say less significantly, but we could expect it when we enter the COVID period in March. Last but not least, I would like to mention another asset class, which is a subcategory of logistic, and which is very trendy at this moment, which is last mile logistic, urban logistic, light logistic, which is a new asset class and is coming up because of the e-commerce activity. Many investment funds and developers are looking at it to diversify their source of investment. Distribution is absolutely key in the development of e-commerce because we need, or the players need to minimize the cost and to move faster the goods. So we are seeing everywhere in Europe the creation of what we call last mile and urban logistics, and this asset class really doesn't exist because there is no standardization of last mile, a part of Amazon, which has its own standard of distribution. The sector is inventing itself through this new asset class, but it's a clear opportunity for investors and for developers to reconvert former industrial plots, for instance, or former. We have seen some transaction with some retail boxes or retail parks in UK reconverted in last mile distribution, and I think this will be a trend in logistics for the next 3 or 4 years. And my forecast is that why not discovering a new activity that we could call co-warehousing, exactly the same that we had co-working or co-living. I'm suppose that in the future we will see some co-warehousing to, let's say, to optimize distribution from small retailers or small player in large platform. To be honest, it does exist already in New York, for instance, and I'm absolutely sure that it will exist in Europe. And in the same case for Europe, I think we will see more and more multi-story distribution platform because of the cost of land and because of the lack of space to develop, let's say, one floor or ground floor logistic platform. So, conclusion, because I can speak during 1 hour and a half if you want.
I know.
I think we are facing very interesting moments. We have our forecast is very, very positive. We are very positive on logistics. So I would say to our guests, let's invest in logistics and let's rely on BNP Paribas Real Estate to advise you.
I like that. Okay, Thierry, thank you very much. Thank you very much. I think that as it was supposed, since this is a webinar moderated by an Italian, we ran a bit out of time, but that's my fault, clearly. I want just, let's say, a bit of summarize. If I understood the key point of what I listened today is that something happened. Something happened it wasn't expected and hit hard the economics and it hard clearly the real estate. For specifics, let's say the expectation is that in the second part of the year, let's say the positive wave in terms of interest of investment from outside Europe, in terms of, let's say, economic internal from the big country, in terms of asset class, the let's say the outlook is let's say moderate positive, I would say, since something is still running, the famous COVID second, third wave. But let's say the pressure to invest, the liquidity is something that the perception that we have in all our sector, market, and countries is something that we have. Before that, I thanks all. We got few questions really fast because also I want to have the answer, so I like that. There is one point. Even Italy in the last let's say 2-3 quarters, we have seen a strong let's say movement of German investor. So let's say the pressure for liquidity for investment from the German investor, the perception we have also from here. The question that I receive, so we have, let's say, I don't want to nominate any specific case, but we are all aware. The perception that we have is that there are some core investors that have not been present until today in Italy. And that this is something that we would like more to understand, why we have some core investors very active. So let's say, I don't want to name anyone because we cannot, but some other that are active everywhere in Europe today are not, let's say, starting, maybe not today, but they've not started still to look at Italy. There is a specific reason why someone is so active and someone is not so active, Javier? That's a question for you. Maybe it's a difficult question, but you are...
Yeah. No, why are some, let's say, some Germans, let's stick for 1 second on the Germans, why some Germans are super active in Italy. We have seen it even at the beginning of COVID. There was a major deal in, I think in Milan, which went through successfully, and my talks with Daniele and the parties which we as BNP know. Why are some super active and being active in Italy is why some not? I would say it's simply saying historical background, yeah, that some in the past had, let's say, some whatever experience, would not say bad experience, and some had good experience and have understood how the Italian market is ticking. Coming from an international view, each market in Europe, and even if you break it down to Germany, each market in Germany has its own rules, his own way of doing business. And when you come from Germany and to invest in Italy, is always the first step is always a bit, okay, how is this working? There are a lot of question marks because the rules are different. If you've passed this once, we've seen that, then there is a real success behind, and they're doing business. Looking forward a bit, I would say it's the opportunity which drives investors into a product, wherever it is. It's nothing to do if it's Italy, it's Romania, it's Spain, or it's Germany, or it's France. It's basically the product which drives the investors. And our role, our advisory role, is really to translate the opportunity which comes out of Italy, as we're talking about Italy, towards the investors which are wherever in the world, to explain the asset and the market rules and to give them a hand and to bring them down if they're not already in this market. Okay. So that's basically the key. But the main message, the main message really, the investment opportunity drives the investors, and not, oh, Italy is a bit different or Spain is a bit different. Yeah.
Okay, so his experience. Okay, thank you, Javier. Last question, then I leave all our guests. Is for you, Yo-Hann. It's not relating Italy, but it's relating to a specific equity that we know that we call sleeping giants, the so-called Japanese pension fund that very strong, very big, but they never arrive in Europe. Let's say it's a big jump to arrive in Italy, but let's say, what happened to this equity? What can we do?
Thank you. That's a very good question, my friend. I think I'll just recalibrate your question. You specifically mentioned about the pension funds, right? I think the Japanese market, you have to see it's tranched into 2 tiers. Those institutionals that would buy into your example of funds, right, indirect, and those, the cash-rich developers. Japanese developers are incredibly sitting on incredible cash piles, right? They would buy direct assets into Italy. So where are they? What's their thinking right now vis-a-vis investing in Italy? We have spoken loads with our Japanese clients, and the feedback we've had is that they are very interested. We have had many queries about investing into European assets and Italy in an indirect way. So even as we speak, we hear the feedback we get from Japanese institutional clients like the pension funds, insurance company like GPIF, Japan Post, are that they would like to buy into funds that are created specifically for Japanese investors. Funds that cover assets such as office, core, structured in such a way for the Japanese market. There is healthy appetite and demand for that. And we see that as a tip that would come in strong, right? And, Japan has always been historically very adventurous. I might even say for an Asian class of investors to invest in Europe. They have invested for a long time in London and in areas in Europe. And they will, and they're watching the market very closely, right? And as you know, in Japan, it is a bit of a herd mentality when it comes to investment. All it takes is one or two to invest into a direct or indirect opportunity, right? And the rest would come. So I would use the word that we expect a tidal wave once it starts. On the second point of your question, which I recalibrated, which is the developers, the Japanese developers, right? As opposed to family offices or private companies or funds, or asset management companies. The second tranche in Japan, Japanese investors are the developers. They would be happy to invest into Europe, into Italy for core buildings. Okay, and this is this is a generational thing. The next wave of Japanese developer investors are new. They were not the ones that invested when their grandfathers invested. So you're talking about a generational shift. You're talking about a behavioral shift. So and that overlays into their risk appetite. The Japanese are by nature very conservative. So for the first wave, they would, even as developers, they will come in and they will acquire core assets, right? They will buy a nice polished building that fits all the requirements of other Asian investors, like I mentioned earlier, the Koreans, the Singaporeans. Then, being developers in their character and nature, we have really heard that they will move up the risk curve as they get more experience.
Okay, thank you. As I mentioned, we have really 30 seconds before I think that, so I want really thank you, all of you. And I think that was very important for us to have your perspective and your view on what is happening abroad. And really, thank you again to take part of this webinar. And I hope that it was useful also for our guests. Thank you.
Thank you.
Thank you very much.
Thank you.
Bye-bye, everybody.
Bye-bye.
Bye-bye. 再见。